let's open up the first thing with checking out the performance of this ARK Innovation ETF. So essentially what this thing is, you can definitely say that it's tech heavy. So it's an ETF that has active management, and they are essentially going out and selecting a basket of stocks that they consider to be innovative companies. Disruptors is what they would essentially call them. These are things like Tesla and Zoom and Zillow and all kinds of companies like that. Roku, things that they consider sort of disrupting the industry. A lot of potential for explosive growth. And this is what it looks like. So the fund launched on October 31st, 2014. So it's been around for about 6.5 years. And you can see the performance here. It's been very good if you just look at the absolute number. If you just look at, well, long-term, 33% return, that's very good. The drawdown's obviously very large, but these are, as we will get into, higher risk tech stocks, so you have to expect some significant drawdowns along the way. And to be honest, I'm not going to talk about it much today about my predictions, but I would imagine that it could get significantly worse than that. But yes, the absolute headline number is very, very impressive, 33% return. The one thing that probably stands out to people, hopefully anyway, is that a good portion of this is recent. This is why I said the emails that I get about this fund has really ramped up over the last, say, 6 months or so. And this is why. You can see it clear as day. So this is slightly cherry picking. I understand this is cherry picking, but it's just to illustrate a point that if we divide this by pre-COVID and post-COVID, we can kind of see what's happening here. The first 5.5 years of the fund, it's not like it was doing poorly, but 13.87 annualized return is fine. And it's really this last year, I guess 14, 15 months, it's up 191%. So this is why that you have probably seen, you probably didn't even know this fund existed. 2-3 years ago, you'd probably never heard of it. And recently, it's obviously getting a lot of news. And this is why. It's up 191% in the last 15 months. Very, very impressive results. And of course, that will lead to the fund itself becoming more popular. It's in all news outlets. Everybody's talking about it. We can see here, there's several of them. ARK actually has many different funds. There's some new ones as well. But it's this yellow one we're looking at, the ARK Innovation ETF. You could say that that's their flagship fund. And that one's in yellow. So we can see that when it launched, it really had no interest at all. And not really surprising. Why would it? It was basically underperforming the benchmark for a few years in the beginning. So not a whole lot of interest there. But then it starts to catch a little bit of attention, starts to do a little bit better. But it's really right here. I mean, we can see it clear as day. This is COVID right here. This is the March 2020. And since then, assets under management for this thing have gone from the low single digits, 2-3 billion for a couple of years, up to right now, I think it's about 22 billion under management. So basically 7 times the amount of assets under management in just the last year. This thing has absolutely exploded. But I think, and again, I'm not telling people not to buy it or to go out and buy it or how great this thing is. I'm just trying to give people perspective. So when I'm talking about things like this, I don't want people thinking, well, he's trying to steer us in a certain direction. I am really just essentially reporting the news. I'm not trying to overlay my personal opinions here. But having said that, if we compare it to the benchmark, which I think is a reasonable benchmark, the underlying Nasdaq, we can see that it, for the first 5.5 years of its life cycle, it essentially didn't outperform its benchmark. Now, on an absolute basis, it was still slightly higher at the COVID period over these 5.5 years. It was less than 1% higher, but it was slightly higher on an absolute level. But on a risk-adjusted level, it had underperformed its benchmark. You can see it started out pretty slow. It had an explosive 2017, very good year in 2017, but the variance is much higher. The drawdowns are higher. The inconsistency is there. So while it did technically on an absolute number slightly outperform the Nasdaq, on a risk-adjusted basis, I would say it significantly underperformed for the first 5.5 years. And then what happened? Well, clearly something has happened in the last year where it has just completely decoupled from the index, and now it's just skyrocketed. Some of you watching, I'm sure you know the answer by now, but in a word, Tesla. This is Tesla stock, right? I'm sure everybody knows what Tesla is. I don't have to go into it. But Tesla was chopping around doing next to nothing for 3 or 4 years before 2020. And then all of a sudden, for whatever reason, and it's a very hot button subject, so I'm not going to try to overlay any opinions about this. It's clearly gotten what most people could probably recognize as a little bit ahead of itself, but I'm not going to say it's, it's the most overvalued or it's a great value. That would obviously trigger a lot of people in the comment section. We're just reporting the news here. As a matter of fact, this thing has exploded in stock price. Whatever you think the reason for that was, great, you can think that. But it went from the 20s, 30s, 50s up to over 700. And if we look at it as a number perspective compared to the underlying Nasdaq, you can see for several years it was doing worse. And then all of a sudden, in the last year and a half, 18 months, this thing's up 1,500%. So, Tesla growing like this, why does that matter? These are the top 10 holdings for the ARK Innovation ETF. So why does Tesla's explosive growth matter? It's their largest holding. They hold 11% of the fund is Tesla. Now, of course, some of that, is if Tesla's stock price keeps rising, well, naturally, it will make up a larger percentage of underlying indexes and ETFs. That's normal to see. But I guess the point is, that's when rebalancing comes in. When something's up 1,500%, you could rebalance. They do have choices here. It's an actively managed fund. But the point is that Tesla, something that's up 1,500%, if it has a 10% allocation, clearly that's why we see things like this. Tesla just exploding higher. Obviously, that's going to be a huge benefit to this underlying ETF. And we can even look at some of these other names, right? Some of you will recognize these names. Square, Roku, Zillow. A lot of these are just crushing it the last year, the last 15 months since that COVID bottom. Whatever happened in that bottom, there were some of these companies that just benefited tremendously. You could say that maybe some of them are based on fundamentals. Maybe some of them are based on just momentum of media coverage. Whatever it is, the fact remains that a lot of those companies that the ARK Innovation ETF has selected have exploded in growth. So credit where credit is due. They have obviously chosen some good companies here. These are the top 5 holdings. The Nasdaq is in turquoise. It is the lowest by a substantial amount. All 5 of their top 5 holdings are really, really doing well. You've got 200, 300, 400, and of course Tesla nearly 1,500%. So good for them. I think that's great. They've obviously selected some good companies. The thing that people have to remember is if you are not a holder of the ARK Innovation ETF yet, and you're trying to get into it, the decision you have to make is how do you think it's going to perform starting today going forward? It's definitely important to look at track records, right? And this thing is not new. It's been around since late 2014. It's important to look at track records, but you also have to be realistic. Ideally, you would want to see a track record that is fairly consistent year to year. Sometimes it's a little bit risky jumping into these momentum things that if you look at a 6-year window, it is making a certain rate of return, but it's largely due to one single outlier year. That makes it more risky. I'm not saying it's too risky, but clearly that will increase the risk. You would rather see something that is consistent in several different types of markets. So that's the question people need to ask themselves. Is this thing starting today, going forward, is it likely to continue the performance it's seen in the last 1 year or the performance that it saw in the first 5.5 years of its life cycle when on a risk-adjusted basis it underperformed its benchmark? I'm not here to tell anybody what the final answer is, but I do manage an investing community and I have to make concrete decisions. So when people ask me this question, should we substitute the ARK fund for something else in our portfolios? What they're essentially getting at, and I know this is specific to VTS, sorry. Let me mute that. This is specific to VTS, so but it will also be meaningful to get to the point. So this is Friday's email that goes out every time. So essentially what my community does, we have 5 tactical rotation strategies. So nothing we do is buy and hold. I'm not a believer in buy and hold. I think the drawdowns are just insanely large when you are handcuffed into holding things long term. Performance is very, very low, as we've seen. So I'm a tactical investor. Strategies rotate between several different choices based on volatility metrics. And so we have equities here, S&P 400 mid-cap. We've got bonds and gold. This is a volatility ETF or volatility strategy. We've got same thing here, tactical rotation. One of them is equities. And then down here, we do have another one that actually holds the Nasdaq. So this is really where people are asking the question. Should we substitute the ARK fund right here? Now, clearly the answer for me is no, because I still use the QQQ. I could quite easily, starting on Monday, I could just let everybody know from now on, this ARK fund is what we're going to be believing in. That's going to be our quasi-equities position here. So we've got bonds when volatility is very low. We've got utilities when the market is going down. But for this equity portfolio within the defensive rotation, I could switch it out and I could go for that ARK ETF. But again, I have to ask myself the same question. I have to look at the data and analyze what's happening, and does it have a place in my portfolio? And for me, the answer is no. And there's main reasons for that being, like I touched on, a massive portion of this performance from that ARK fund is happening just in the last 15 months. And that in itself, for me, is a little bit of a red flag. I like to see performance consistent through different market environments. I would have liked to see the ARK ETF perform just as well coming out of the market crash in 2015 as it did coming out of the COVID in 2020. I'd like to see it have really good performance coming out of the Volpocalypse in 2018, the Q4 crash in 2018. It didn't. There's just something new in this market where these tech names have just caught fire. We can't deny the performance, but is it repeatable? That's the question. So for me personally, I have stuck to the QQQ within our defensive rotation strategy. I don't like the fact that I can't really predict how this thing is going to perform in different environments. As an example, this is our performance of that strategy. And of course, since COVID, we've also done very well. But focus on this last period for a second here. The markets are at all-time highs, so this is not a surprise, right? I'm not reporting anything and saying, wow, we're doing incredibly well, we're crushing it. We are, but the market is also at all-time highs, so this is fairly expected. The ARK fund, let me see if I can pull this up here. I didn't have it before. But let's go to the last 3 months of this fund, and you'll see what I'm talking about here about the consistency. So this is measuring against the Qs. The Qs in turquoise, all-time highs. Everything's fine. The ARK fund has gotten crushed in the last 3 months, even though the stock market is at all-time highs. If we remove the Qs here, this thing went from 156 down at the lows to 110. That's an over 40% drawdown while the markets are at all-time highs. Now, for me, as a long-term tactical investor, I need to know how the underlying assets I'm holding perform in different environments. It is one of the most important aspects for me to understand the correlations, to get a good idea of how what I'm holding is going to perform if X, Y, and Z in the market happens. With something like the ARK Innovation Fund, that is a hand-picked basket from a team of obviously very smart people, we don't know that that's the case. So right now, I like the fact that my portfolio is at all-time highs. It should be. The market is at all-time highs as well. Most of my work is focused on drawdown reduction. So of course I have plans, contingencies in place. If the market crashes, we will be able to profit from that as well. But the market's at all-time highs, and I need to know that my positions that are quasi-equity positions, they are also at least near all-time highs. I can't invest in something that at any moment, despite the market doing well, it could be down 40 or 50%. I simply can't. So for me personally, that is the answer that I've been sort of driving towards, is there's no way that I could use this fund, given its performance, despite the fact that the absolute number is good, how it got there is not consistent enough for someone like me to be using it in my strategies. So the last question I want to touch on is I want to offer a solution to what people could do if they're trying to get that explosive growth. Obviously, the reason that people would use this ARK Innovation ETF is because you look at the numbers and you also want to participate in something that is crushing the market. There is a solution for that, and I sort of pointed to it, but let me just show you exactly. This right here is a comparison of the ARK Innovation ETF to the 2 times Nasdaq, the QLD, right? There's QLD is a 2 times, there's the TQQQ, that's a 3 times. There are leveraged Nasdaq ETFs. There are leveraged S&P 500, S&P 400, there's leveraged Dow. There's all of these available to us. Look at the performance of the leveraged QLD compared to the ARK Innovation. Of course, those first several years, I probably should have shown a log scale now that I'm speaking out loud. But anyway, the gap here, this is actually a pretty significant gap. So the first 3 years, of course, the QLD was crushing it. And then right here, this is when the ARK Innovation ETF took over. But you can see the 40% drawdown right there. That's a massive decoupling. But there's nothing wrong with using the QLD if you're trying to boost performance. Because at least in this case, again, you're not dependent on a team of stock pickers to get you the performance of 2 times the market. You are only dependent on the market. So what would you rather invest in? Something, let me try to scale this. I don't know if you're even going to see it very well. Let me try to scale a side-by-side comparison of the top holdings of the Nasdaq compared to the top holdings of the ARK Innovation ETF. You can see the difference in these names, right? Of course, these are what they deem to be the disruptors. These over here, as far as the QQQ, these are the largest companies in the world. These are Apple, Microsoft, Amazon. Not that they're not explosive growth companies, they are, but they've already gone through those phases where they're not likely to see that 1,500% Tesla growth. The only reason Tesla's even here is because it grew 1,500%. This is a market cap weighted ETF. So of course, the bigger the company gets, the more weighting it has in the underlying index. That's why Tesla's here. But it wasn't before. It was far lower than that. But these companies, most of them, and certainly if we drop down another 20 or 30, most of them have already gone through that initial explosive phase, and they are more stable. I wouldn't say that Apple, Microsoft, Amazon, they could also drop substantial amounts pretty much at any moment, but it would be because the market is dropping, not independent of the market. These companies essentially are down, they had a drawdown of 40% while the markets were at all-time highs. Obviously, just by pure definition of an index, that can't happen if this is what you're holding. You are holding the market. So again, that's the question. Starting today going forward, what would you want to invest in? Would you want to have something that essentially tracks the market? If the market's at all-time highs, you can predictably use that ETF in your own strategies. Whether that is buy and hold, of course, that's not something I do, but it would be predictable. Markets are here, your portfolio looks like this. Markets go down, this is what you could expect to happen. Correlations hold up over time. You can measure things versus bonds and gold, and there's a long-term track record. You can't do any of that with the ARK Innovation ETF because it's entirely discretionary. It's based on holdings that, again, credit where credit is due. They have selected some pretty good companies the last year, better than I did. I don't go choosing individual stocks, so I'm not here to beat them down in that sense, but it's unpredictable. How can we possibly know the forward progress of where this thing is going to go? We can't. So, like I said, there is a solution, and I personally do use that solution. We also have a leveraged version of our defensive rotation strategy. Same strategy, same signals. We just find ways to use leverage whenever possible, and that's what I use within this. I use the QLD, 2 times Nasdaq, as whenever we're holding equities, that's what we will be in. This strategy also does hold bonds from time to time, utilities as well. But when we're in equities, I really do need to know how it's going to perform. That is the key. Starting today, going forward, I need to be able to actually analyze this. I need to be able to get all of the beta factors in my spreadsheets and make some realistic forward predictions. Everything is uncertain. Certainly possible the ARK just continues its meteoric rise. But I think people have to be realistic for the fact that as the old saying goes, what goes up must come down. I'm not necessarily saying that's going to happen or that it's imminent, but please understand that we saw the same thing during the dot-com bust. The Nasdaq at that time dropped 78%. There were a lot of individual names that dropped a lot more than that. So you have to understand, something that goes up 1,500% in 1 year, it is a brilliant story. And anybody who participated, congratulations. But you have to understand that there's a very far distance between where it came from to where it is. That's not true for an index. The index is the index. So long story short, and this is why I like to do these live streams, to just be able to show all this data. It's much better than an email. Long story short, for all the people that are asking me, shouldn't we insert this super exciting ARK Innovation ETF into our tactical strategies? Wouldn't we be better off? No. In my opinion, no. I use the underlying Nasdaq as our unleveraged holding, and I use the 2 times leveraged ETF, QLD, for our leveraged holding. And for me, that's predictable. That I can actually analyze. I can quantify where it has been, where it's going to go, how it reacts to the market. So congratulations to everybody who held the ARK up 191% in the last 15 months. That's pretty impressive. But I will certainly be keeping an eye on it, and maybe I'll do another stream about it a year from now. Like I said, we all need to make decisions starting today going forward. This is one of the major problems in the investing world that a lot of people don't understand until it happens to them. But you look at something, say a hedge fund, for example, and they report a headline number. This hedge fund has made 30% a year for the last 6 years. But what you realize is the drawdowns might be insanely large, and that would mean that you would have exited that fund when you panic sold, right? That's what happens. We're all human. Emotions are involved in investing more than people realize. And if you panic sell, you're out, and then the fund recovers, and you're not there to participate. So that headline number that looks so amazing on paper, realistically, for real people to be tracking it year to year to year, it's not realistic at all. And the same thing you could say for this ARK fund. Just looking at it, just imagine you're an investor. Insert yourself into this page. You are an investor who held this thing from the beginning. For the first 3 years, you got nothing from it. It wildly underperformed what you thought it was going to do. Of course, you pulled the plug here, right? Right here, there's no assets under management. We know that. We can see the data. That right here, it didn't even register on the assets under management chart, remember? That's here. There's no money here. But then the thing starts to skyrocket. So what do people do? They chase shiny objects. They see something doing really well. And right here, people start to buy along the way up. And it had a tremendous year. And some people early on might have participated. But then it went through a very long period of chop where you wouldn't really have wanted to be holding it anymore because even the benchmark is doing better than this fund. So a lot of people would have been exiting and panic selling during these big drawdowns. But then it goes on an explosive run. Maybe it sucks people in here. So you buy again. And then what happens? You have a 44% drawdown and you pull the plug again. Then it shoots higher. You're not in it for this growth. But then eventually you look at it and you say, well, how can I not be? I have to join this thing again. So you join it somewhere on the uptrend and then boom, a 40% drawdown hits you again. So a realistic investor, an actual person with emotions, would never have buy and hold this thing for 6.5 years. You wouldn't have been in it here. You would have missed this phase, or at least the first part of it, because only when it made the news would you have even known it existed. And then you would have probably sold either here during a very choppy, extremely unstable flat period, and then a massive crash. You wouldn't have gotten this. You maybe jump in, maybe you get this, but then you're down again 40%. So it's not enough to look at the average long-term rate of return and just say, I want that number. Investing is far more difficult than that, and it's far more emotional. And I would submit that there aren't that many people who could have made rational decisions all along the way with this fund. And a lot of hedge funds are the same. You see them raising massive amounts of capital. While they're raising the capital is when the performance dwindles, right? The big numbers that suck people in are all the good times when nobody knew it existed. And then all of a sudden it hits the news, a whole bunch of people pour into it, and then you start noticing, wow, as a real investor with real money, I didn't get the number that hedge fund reported. I didn't see that in my actual account. That's why it happens, because how something gets to that number is more important than the number itself. The annualized return, sure, it's valuable to know that number, but how it got there, focus on that, and you'll make better decisions. So for me personally, I don't like how the ARK fund achieved its 33% return. How can a quant investor like myself look at that and honestly think I can somehow predict the future of how my strategies will perform? I can't. It's all over the map. I'm not saying it's bad. The number's obviously good. I can't. So for me personally, QQQs, QLD for leverage, and good luck to everybody who's holding it. I hope it continues well for you. But I'd be a little worried when I look at those top holdings. I think, boy, if the markets start to decline, I would bet good money that the ARK fund has a much larger drawdown than the broad market does. Not for sure. I'll certainly come back and update everybody, but that is my opinion, that the bottom could really drop out on something like that. Just like it did in the dot-com bust, there were many, many good, solid companies, individual names, that dropped well over 90% during that period. So it will potentially decouple again from the underlying index even more. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.